Most traders lose not because their setup is wrong, but because they enter at the wrong time. In this video, I'll show you a simple day trading strategy that helps you spot real reversals and trade in the right direction, step by step. Here's what you'll learn: how to recognize hidden market shifts before the big move starts, how to filter false breakouts and avoid trap zones, a clean confirmation checklist using smart price behavior, multi-timeframe alignment so you trade with the main trend, real chart walkthroughs with exact entry, stop loss and target examples, works on 1, 5, 10 and 15-minute timeframes, applicable to forex, stocks, crypto, commodities and futures. By the end, you'll know exactly where to enter, where to place your stop and how to choose realistic targets with confidence. Before we get started, please take a second to hit the like button, subscribe and turn on the notification bell so you don't miss the next strategy breakdown. Let's get started. To recognize hidden market shifts before the big move starts, we need just one simple strategy: RSI Divergence. Before we talk about divergence, let's first learn how to find and add the RSI on your chart. On TradingView, go to the top of your screen and click on Indicators. In the search bar, type RSI and select Relative Strength Index. Once you click on it, the RSI will appear automatically at the bottom of your chart as a separate window. You'll see a line moving between two levels, 0 and 100. Now, let's understand what this indicator actually shows. RSI stands for Relative Strength Index. It's a momentum indicator that measures the speed and strength of price movements. It tells you when the market is overbought or oversold. In other words, when price might be ready to reverse. When the RSI is above 70, it means the market is overbought and price could soon start moving down. When the RSI is below 30, it means the market is oversold and price could soon start moving up. So the RSI gives us a quick visual clue about when momentum is slowing down, but that's just the beginning. The real power of the RSI comes from spotting something called RSI Divergence, one of the most reliable reversal signals in technical analysis. Look at your chart and compare the price highs or lows with the RSI highs or lows. If price makes higher highs, but the RSI makes lower highs, that's a bearish divergence. It means buyers are pushing the price higher, but momentum is getting weaker. A sign price could soon fall. If price makes lower lows, but the RSI makes higher lows, that's a bullish divergence. It means sellers are pushing price down, but momentum is slowing. A sign price could soon rise. Now that you know how to spot a regular RSI divergence, here's something most beginners don't realize. Divergence alone isn't enough to take a trade. Yes, divergence tells you that the trend is losing strength, but it doesn't tell you when price will actually reverse. Sometimes price keeps pushing in the same direction even after a divergence appears. Why this happens? The market often needs to grab liquidity before reversing. In other words, it hunts the stop losses of retail traders who enter too early. That's why if you buy just because you see a bullish divergence, price might still drop lower to take out your stop before going up. And if you sell just because you see a bearish divergence, price might still push a little higher, take liquidity, and then reverse. Instead of entering immediately when you see a divergence, you want to wait for confirmation, a clear sign that smart money has finished grabbing liquidity and that the reversal is real. That confirmation comes from something called a liquidity sweep, a simple but powerful concept that helps you spot where the market traps traders before making its real move. Before we combine it with RSI divergence, let's first understand what a liquidity sweep actually is. This concept is simple, but it completely changes how you see the market. So what is liquidity? Every time a trader buys or sells, they place orders in the market, and above every recent high, there are buy-stop orders from traders who went short. Below every recent low, there are sell-stop orders from traders who went long. These areas, above highs and below lows, are pockets of liquidity. The market needs that liquidity to fill large institutional orders. A liquidity sweep happens when price spikes above a previous high or drops below a previous low just long enough to trigger those stop losses, and then quickly reverses. Why it happens? Smart money. Institutional traders need liquidity to enter large positions. They can't just buy or sell anywhere. They need to find areas filled with pending orders. So they push the price into those zones, trigger retail stop losses, and use that liquidity to enter their own trades in the opposite direction. That's why most retail traders lose at those exact spots, because they're entering while the smart money is entering against them. Now that you understand both concepts, let's put them together into a clear step-by-step strategy. This is where things get exciting, because when RSI divergence and liquidity sweep happen at the same time, it often marks the exact turning point of the market. First, look at this area on the chart. We have a recent swing low that many traders are watching. Below that low, there are hundreds of stop losses from traders who went long earlier. This area becomes a liquidity zone, and that's where smart money often looks for entries. Now watch what happens next. Price suddenly breaks below that low, taking out all the stops sitting underneath. That quick push down is called a liquidity sweep. The market collects sell stops, fills institutional buy orders, and then immediately snaps back up. As price made that lower low, look at the RSI below the chart. Instead of following the price, the RSI made a higher low. That's a bullish regular divergence. Price is falling, but momentum is rising. It's a clear signal that sellers are losing control and buyers are stepping in. Right after the sweep, a bullish candle forms. This is your confirmation that the reversal is starting. This is the moment where both pieces of confluence come together. Liquidity swept, RSI divergence confirmed, and buyers taking control. Once the candle closes, you can enter a buy trade. Entry, after the candle closes. Stop loss, just below the sweep's low. Target, the next resistance, or a 1-to-3 risk-reward ratio. Now let's look at the opposite situation. A bearish setup using the same concepts. Liquidity sweep plus RSI divergence on the 5-minute chart. On the chart, notice this recent swing high that stands out. Many traders who sold earlier have their stop losses sitting just above it. That makes this area a liquidity zone, full of buy stops ready to be triggered. Watch what happens next. Price pushes above that high, grabbing all the buy stops, but then quickly reverses back down. That short-lived breakout is the liquidity sweep. The market collected liquidity and trapped breakout buyers at the top. Now look at the RSI panel below the chart. As price made that higher high, the RSI made a lower high. This is a bearish regular divergence. Price is still climbing, but momentum is fading. Buyers are running out of strength. Immediately after the sweep, a bearish candle forms, showing strong rejection. This candle confirms that the liquidity grab is complete, and sellers are taking control. Here's how to trade it. Entry, after the bearish candle closes. Stop loss, just above the liquidity sweep's high. Target, the next support zone, or a 1-to-3 risk-to-reward ratio. So far, we've seen how powerful the combination of RSI divergence and liquidity sweep can be. But no strategy is perfect, and sometimes even the best setups fail. Let's look at an example of a failed trade on the 5-minute chart, and I'll show you exactly why it failed and how to avoid making the same mistake. Here, we're on the 5-minute time frame. Price forms a lower low, and the RSI shows a higher low, a clear bullish divergence. Then we see a liquidity sweep below the previous low, followed by a bullish candle. Everything looks perfect, just like the examples we saw earlier. The trader enters a buy position, expecting a reversal. But instead of going up, price quickly reverses back down and hits the stop loss. So what happened? The setup was technically correct, but the market context was wrong. Let's switch to the 30-minute chart to understand the bigger picture. On the higher time frame, you can see that the overall trend is moving against our bullish setup on the 5-minute chart. Notice how the market was trending upward, then formed a double top, followed by a liquidity sweep, a clear signal of a potential trend reversal. After that, price started to reverse and trend downward, which goes completely against our buy trade on the 5-minute chart. Now, let's go back to the 5-minute chart trade. As you can see, even though both the divergence and the liquidity sweep are present, we should ignore this setup, because the signal goes against the overall market trend. This example teaches an important lesson. Never trade against the higher time frame trend. A bullish signal on a 5-minute chart doesn't mean much if the 30-minute or 1-hour chart is still bearish. The market can easily invalidate your setup, because smart money is following the larger direction, not the small pullback. RSI divergence and liquidity sweeps are powerful tools, but they only work consistently when they align with the higher timeframe structure. Always remember, the higher timeframe gives you the market's true direction, and the lower timeframe gives you the entry. So if you're trading on the 1-minute chart, make sure the 15-minute chart is trending up and showing signs that support your trade. If you're trading on the 5-minute chart, always confirm that the 30-minute chart is aligned with your direction. And if you're trading on the 15-minute chart, look at the 1-hour chart first. Make sure the trend supports your idea before you pull the trigger. When both timeframes agree, you're trading with smart money, not against it. and that's when your win rate improves dramatically. Let's go through a complete example, step by step, so you can see how to combine RSI divergence, a liquidity sweep, and top-down analysis before entering a trade. On the 5-minute chart, price forms a lower low, breaking just below a previous swing low. That small break takes out the stop losses of earlier buyers. That's our liquidity sweep. While price is making that new low, the RSI shows the opposite story, a higher low. This is a bullish regular divergence, which tells us sellers are losing power and buyers are starting to step in. Before taking any trade, we need to confirm that the higher time frame agrees with our idea. So we switch to the 30-minute chart, and here we can clearly see that the market is trending upward. There's a demand zone in this area, and price has just reached that zone and started to push upward strongly. As you can see, there's strong buying pressure and the market could continue rising toward this resistance level. This tells us that the market is likely to keep moving higher, which supports our trade idea. After confirming the higher time frame trend, we return to the 5-minute chart. The candle that closes above this level confirms that the liquidity sweep is complete, and that's our confirmation signal to enter the trade. Now we can safely execute the trade. Entry, right after the bullish candle closes. Stop loss, just below the level. Take profit. Next resistance level, or a 1-to-3 risk to reward ratio. Because the setup and the higher time frame are in perfect alignment, price begins to rally right after entry, moving straight toward the target and reaching it smoothly. So that's how you use RSI divergence and liquidity sweeps the right way, with top-down analysis. If you found this video helpful, give it a thumbs up, subscribe to the channel, and turn on the notification bell so you never miss the next strategy breakdown. Thank you for watching and see you in the next video.